Most investors think they know which ETF is best for long-term growth, the one that's always dominating headlines. But what if the truth about how a $100,000 investment grows in VOO versus SCHD isn't what you expect? You might be missing out on a strategy that better fits your financial future. You put $100,000 into VOO or SCHD. Which one actually grows more over the long term? That's the core question. Many wonder if the growth focus of VOO always beats the dividend stability of SCHD. I'll break down the specific factors driving their performance differences. This isn't just theory. I've analyzed over a decade of real historical data and run a direct $100,000 backtest. Get ready for a clear, data-driven comparison of these two investment giants. All right, let's talk about VOO. Many investors see this ETF as the go-to way to get broad exposure to the US stock market, and for good reason. Imagine the S&P 500 index as the ultimate scorecard for America's biggest companies. It's widely recognized as the main measure for the US stock market, tracking the investment returns of 500 large US companies. When you hear about the market's performance, they're often talking about the S&P 500. The Vanguard S&P 500 ETF, or VOO, is built to simply match that S&P 500 index as closely as possible. It's a passively managed fund. This means it just buys all the stocks in the index, in the same proportions, without anyone trying to pick winners or losers. This strategy is super efficient if you want to capture the overall market's growth. One of the coolest things about VOO is its incredibly low expense ratio, sitting at just 0.03%. That's practically nothing, meaning more of your money stays invested and works for you. It also manages a massive amount of money, over $1.3 trillion, with the ETF share class accounting for $608 billion. This huge size ensures it's easy to trade, so you can buy or sell shares without issues. When you look inside VOO, its holdings really show how the S&P 500 is structured. As of June 2025, a big chunk of it, 30.35%, is in information technology. You'll also find significant allocations in financials at 14.39% and healthcare at 10.84%. This heavy tech weighting has been a major driver of the S&P 500's returns lately. Its top holdings are exactly what you'd expect. Giants like Apple, 6.75%, Microsoft, 6.22%, and Nvidia, 5.64%. This means VOO's performance is really tied to how well these big tech companies are doing. Now, let's switch gears and talk about SCHD. Many investors, especially those looking for a steady income stream, swear by dividend ETFs. Is SCHD that reliable, consistent choice you might be looking for in your portfolio? The appeal of dividend investing is huge. Imagine getting paid just for owning a stock, and then using those payments to buy even more stock. SCHD aims to track the Dow Jones US Dividend 100 Index. Unlike VOO, which focuses on broad market cap, SCHD is all about quality dividend-paying companies. Its underlying index selects U.S. companies that have consistently paid dividends for at least 10 years. But it's not just about paying dividends. SCHD also screens for financially healthy companies using factors like cash flow to total debt, return on equity, ROE, dividend yield, and 5-year dividend growth rate. This screening process helps avoid what are called yield traps, companies that offer high dividends but might be in financial trouble. Just like VOO, SCHD has a very low expense ratio of 0.06%. While slightly higher than VOO's, this is still incredibly competitive, especially considering the more complex, rules-based screening it uses. SCHD also has a substantial amount of money under management, around $68.2 billion as of early June 2025. This shows strong investor trust in its dividend strategy and ensures good liquidity. When you look at SCHD's portfolio, it's quite different from VOO's. As of June 2025, it leans heavily into more traditional and defensive sectors. Consumer staples makes up 19.4%, energy is 18.9%, healthcare 14.5%, and industrials 13.3%. Its information technology exposure is much lower at just 8.9%. This allocation comes directly from its focus on steady, dividend-paying companies. Its top holdings include well-known names like Coca-Cola, 4.29%, Verizon Communications, 4.28%, and Cisco Systems, 4.28%. This distinct profile means SCHD might offer more stability in certain market conditions, but it could lag during periods when tech growth explodes. We've looked at their individual strengths, but the real question is how they stack up against each other. Stick around, because a surprising truth about long-term compounding is coming later in this video that most investors overlook. All right, let's stop talking theory and get into the real numbers. What does the actual history tell us when VOO and SCHD go head-to-head? There's this common idea out there. Either growth ETFs always win, or dividend ETFs are always the safer bet. But the truth is, the market rarely moves in a straight line, and different strategies shine in different conditions. It's crucial to look beyond simple assumptions and examine their performance through various market cycles. First, let's look at their compound annual growth rates. This basically shows how much your investment would have grown each year on average, assuming you reinvested all gains. Over the past 5 years, VOO has posted a compound annual growth rate of 15.90%, while SCHD delivered 12.23%. If we stretch that out to 10 years, VOO's compound annual growth rate was 12.82% compared to SCHD's 10.58%. Since inception, VOO, which started earlier in September 2010, has a compound annual growth rate of 14.25%. And SCHD from October 2011 shows 12.23%. This clearly shows VOO has historically delivered a higher compound annual growth rate across these periods. This outperformance largely comes from the strong run of U.S. large-cap growth stocks, especially in tech, which VOO is heavily exposed to through the S&P 500. So, you've seen the historical performance, but what if you actually put your money on the line? Imagine this. It's October 20th, 2011. And you've got $200,000. You decide to split it, putting half into VOO and half into SCHD, and just let it ride, reinvesting all your dividends. How would those investments have grown over the next almost 14 years? This isn't just a thought experiment. We're looking at a simulated real-world scenario based on actual historical data. This backtest reveals some pretty eye-opening results. If you had invested that initial $100,000 in VOO, your investment would have grown to a final portfolio value of $635,000. That's an overall total return of 535%. Now, if you had put that same $100,000 into SCHD, your final portfolio value would have been $485,000. That's an overall total return of plus 385%. Looking at those numbers, VOO clearly generated a significantly higher final portfolio value over this specific period from late 2011 to mid-2025. This reinforces what we saw with the compound annual growth rate figures, highlighting the strong performance of U.S. large-cap growth stocks, which are the primary drivers of VOO's returns. Even with SCHD's consistent dividends being reinvested, the capital appreciation from VOO's holdings was just stronger during this time frame. This shows a common trade-off in investing: the potential for higher overall growth from a strategy like VOO versus one geared towards higher current income and dividend sustainability like SCHD. Interestingly, when the market hit its sharpest downturn during the COVID-19 crash, both ETFs experienced very similar maximum drawdowns on March 2020. VOO dropped by 33.99% and SCHD by 33.37%. This suggests that during such extreme, sudden market shocks, SCHD's dividend and quality screens didn't necessarily offer substantially more downside protection in terms of peak-to-trough decline compared to broad market exposure. However, remember, their performance in other less severe downturns or different market conditions can vary significantly. Okay, we've broken down VOO and SCHD, compared their numbers, and seen what makes them tick. But the ultimate truth about these two ETFs isn't just about their individual performance. It's about understanding which one genuinely fits your specific stage of life and financial goals. A common mistake many investors make is looking for the one best ETF for everyone. They might hear VOO had higher past returns and think it's automatically the default, or that SCHD's dividends make it universally superior. But here's the truth I promised. For most investors, especially those with a long-time horizon, VOO often represents a better core pick for broad market diversification and growth potential. Its superior historical total returns over the last decade highlight its ability to capture the market's overall upward trajectory, driven by leading U.S. companies. On the other hand, SCHD is generally a better pick for investors closing in on retirement, or those who prioritize a higher current income stream and a degree of stability. Its focus on financially sound, dividend-paying companies results in a more substantial dividend yield of 3.92% and can lead to significantly smaller losses during certain market downturns. While its total returns might have lagged VOO over the specific period we analyzed, its emphasis on quality and consistent income can be invaluable for those in or nearing their income-generating years. But the real secret to maximizing your returns isn't about picking one of these fantastic ETFs over the other. The most effective strategy is actually to build a powerful, well-diversified portfolio using several ETFs, leveraging the unique strengths of each. I dedicate an entire video to showing you exactly how to construct that kind of multi-ETF portfolio, which I encourage you to check out. If this breakdown helped you understand VOO and SCHD, subscribe for more in-depth financial insights. Want to dive deeper into optimizing your portfolio for long-term wealth? Watch this next video on your screen.